from 1949 to 2025. If you understand this chart, you understand how markets actually behave. Now, hopefully you get to see the pattern. Look at chart number one. This chart basically splits the last 75 years into two colors. The blue, which is the bull markets. Now look how thick and big they are and long, right? And look at the red bars. Bam, bam, bam. As you could see, keeps everyone honest once in a while. The numbers above each blue tells us how long the bull market lasted. And the total return from bottom to top. For example, 7.1 year, 487%. Look at those numbers. I mean, the market rose nearly 500% over 7 years. And then, of course, the red, meaning 1.2 years, minus 18%. The pattern, big multiple bull runs followed by short, violent downturns, tells a very important story. Bull markets last a long time, obviously, right? Bear markets are sharp and short. And this is what they mean by the fat tail. That means that it's like chaos theory. We don't know what's driving. All we know is one is impacting another. I mean, go to the casino. Have you been to see the roulette wheel? Why do you think they want to make sure that roulette wheel is always flat? Right? Well, because, right, if it's like that, then the odds for the balls to hit on that side, on that corner, is higher than on this side. So therefore, each spin of the wheel, yes, is different. One action impacts another. One stock impacts another. Once you have that, it's impossible to predict anything. So the average bull market lasts about 5 years and gained 254%. The average bear market lasts 1 year and loses 31%. The problem that you're having is that like I said, you're not going to ever be able to benefit from 75 years. Right? By the time you're 10 years old, you don't understand anything. By the time you're 85, you forgot everything. The problem is that do you want to be the one that's been investing in a dot-com bubble? And you lost 80% of your money, and it took 15 years to recover. You are cooked. This is a very important thing to understand. These are facts. Look at the early post-war boom, 1949 to 1968. 7 years, 487% between 1949 and 1956. Right after World War II, the U.S. economy shifts into industrial overdrive. A 7-year bull market begins the first massive post-war boom. S&P rise almost fivefold. Factories are humming. Middle class is exploding. America becomes a global manufacturing superpower. Like right now, the U.S. is a superpower. Well, China is, and we'll do a video on China, but China is very close. Careful. Anyway, back to the story. 1956 to 1957, 18% bear market. Not catastrophic, not prolonged, just a standard reset. And then we're back on again from 1957 to 1961, 114% in 4 years. Then we drop a little bit, 27% in 26 years, in 6 months. This is the first sign of panic-driven selling in the modern era. 1960, I don't know if you may or may not remember, 1961 to 1962, 27% in 6 months. Now, remember one thing. When we talk about going up, going down, going sideways, you have to remember that whatever goes up also must come down, meaning that if you're losing 27%, for you to get back to what you lost, right? If you have $10 and you lose 5, right? You lost 50%. For you to go from 5 to 10, you need to make 100%. That's the difficult part. That's a very, very difficult part because you need to make twice as much just to get back where you were. So remember that. Next. After the 61 to 62, 27% 6 months, but the market pattern holds. A bull market dominate and bear markets are interruptions. Look at the chaotic 1960 to 1970. 103%. 103% from 1962 to 1966. Economy grows, industry expands, another strong run. And then, of course, 66 to 67, a 20% bear market. You see the pattern? 1967 to 1968, 58% bull market. And then we have the bear market again. And it goes up and down and up and down. And the 80s, of course, that was a bad one. That's the VOCA, the recession and recovery. And let me say something about 1980 with VOCA, recession and recovery, right? From 1974 to 1980, 204% bull market. Inflation is defeated. Growth comes roaring back. And then 1980 to 1982, 20% bear market, right? But then the market recovers again. So who knows? The point being is that what happened during that time, what happened during the VOCA time, well, there is something to be said, right? And basically what we're saying, and this is, I have a chart that shows you exactly what happened in the 70s, 80s, and what's happening today in terms of inflation, and we're following exactly what's going on. And basically at that time, believe it or not, it's exactly what's happening, meaning that at that time, Nixon wanted lower rates, administration wanted lower rates, and he got lower rates. Basically, the Arthur Burns, who was the Fed chair at that time, basically said, whatever you want, I give it to you. And he gave him lower rates. And what's happening right now, right? Unfortunately, inflation wasn't taken care of. Don't forget, in the 70s, before 70s, the U.S. went into a war, right? And we needed to spend lots of money, and that created inflation. But tried to lower the rates, and inflation and rates don't mix well together. And what you ended up happening, you ended up having hyperinflation. So Volcker came in, and he just raised the heck out of the rates, creating a recession, and that's why you got yourself 20% bear market from 1980 to 1980. But at the end of the day, the market recovered. And then you have the 1990. That was a tech revolution. 121% bull market, and then 20% bear. 1990 to 2000, right? Low rates. Well, I don't want to bring up the 50-year mortgage, please. I mean, I did a video on that. That's ridiculous. There is no such thing as a 50-year market, 50-year mortgage. Why? Because at the end of the day, you cannot. What the 50-year mortgage will do, it will lower your payments, but you will never pay your house. And of course, if everybody jumps on it, guess what's going to happen? Prices are going to go up. It's going to probably nullify the fact that your payments are lower. Don't do it. I mean, it's like the same thing with the $2,000 refund. That's never going to happen. From 1990 to 2000, the longest and strongest bull market of the 20th century, 841%. For 12 years, that went up. Personal computing went up. The internet, falling interest rate, globalization, corporate profitability, they went nuts. They literally went nuts. It was euphoria, and like all euphoric periods, it ends violently. 2000 to 2002, 47% bear market. It just wipes out everyone. And then, of course, you've got the crisis after crisis at 2000. So 2002 to 2007, 121% bull market. Fantastic time. I remember. Wow, we made a lot of money. 2007 to 2009, minus 55%. Now, that's even worse than 2000, 2002. That was 55%. And what made it worse, it wasn't just stock market at that time. It was a global financial crisis, the worst decline since the Great Depression. You almost lost the financial system, literally. If Congress had not come in with the top to buy those bag assets, we would have lost the financial market in the US. And then 2009 to 2020 super cycle, we're back again, 527% bull market for 11 years. Why? Well, we had a zero interest rate, quantitative easing. The Fed was just saying, hey, whatever. Massive corporate profit, the rise of the big tech, globalization, cheap capital, again, the same themes. And of course, then COVID, that came out of nowhere. 34% drop in 1 month. But now we're back up again. 121% bull market, 2020 to 2021. Stimulus check, rate cuts, record liquidity, options mania, tech explosion. And then 2021, 2022, 24% bear market again. Now we are in the 78% bull market. The only thing you will notice, one thing, is that it's happening more often. Be careful. AI mania takes over, tech becomes the entire market, the Magnificent dominate everything, and finally, the 2020, 24, 2025 bear market. Believe it or not, the US is not doing that great in terms of stock market return. And that's unfortunately what is happening. Don't forget to subscribe to this channel or join my Patreon or become a member, because then I become more specific. Because when I say, well, go buy small stock and do interesting things and make money in the stock market, but where, how, right? I picked a bunch of stocks at the beginning a couple of months ago. Studio with not Nvidia, none of this stuff. We're talking about small stocks. What I mean small stocks, small caps, a low PE ratio, good earnings. There's a lot of them. And right now, what's happening is, everybody wants to buy those. Why? Because they are cheap. You want to buy cheap stocks. That's what you want to do. But then, of course, you need to buy a story. Quantum computing is becoming a thing, so keep that in mind. Although this is very difficult because they're losing money right now. But quantum computing is going to multiply the power of your computer by 10,000. That's going to have a huge difference. 2, rare earth minerals. The US cannot rely on China anymore, and they realize that. So you need to build your own rare earth mineral system. That doesn't happen overnight. That could take 10 to 12 years. Gold. You got to get some gold because with inflation. So you need to build a portfolio which got a bunch of different things in it. You can even look at some ETF, leverage ETFs. I've got a couple of recommendations. Be careful because those actually do very good if the market drops, or they do very bad if the markets go up, depending which strategy you want. You could play all different type of stuff with it. But the point is, understand the overall picture. What is going on with the overall picture? And the overall picture that I'm telling you in these charts is basically that we are on the way up right now until we're on the way down. But we're on the way up because we just started. Look at all the charts that I showed you before. We're basically at the beginning of these bulls and what do you compare to the others. And usually you collapse because of something major. You don't collapse because people think we're overvalued. What does that mean? Something has to happen. Something needs to trigger it. And this is not the dot-com bubble, because the AI bubble is still very strong because these people are making actual products. Tesla is going to come up with robots pretty soon. Cars driving itself. Now, are we paying for the stock too much? Yeah, but the guy's coming up with a bunch of different things. Therefore, we need to realize that. So that's going to keep it going. All right. So remember, buy when everybody else is selling, sell when everybody else is buying, and this bull market has more to go. But watch for the top. Don't forget to subscribe.